Hi everyone, Nick here. Welcome back. Since 2010, US stocks have outperformed ex-US or international in 12 out of 15 years, or 80% of the time. Ex-US diversification has not paid off recently. This leaves many investors questioning whether they should start or continue to invest in ex-US stocks. And after the recent US election, many people believe that the US will be even more competitive for taxes, regulations, and so on to the advantage of US companies. In this video, we'll look at some of the advantages of investing in the US, some statistics compared to ex-US. Then we'll look at a couple considerations I think many people overlook when deciding on their ex-US allocation. So let's just start by looking at some of the top holdings in the US and ex-US indices. This is the Vanguard US Total Stock Market Index here. And as you can see, the US has many of the biggest, most innovative and successful companies in the world that have been seeing the most growth in the recent past. If we compare this to international, there are also some great companies there. They just haven't been growing as much or growing profits as much as the US has recently. So if we scroll up, to evaluate this, we're going to look at characteristics, which will give us some aggregate statistics for this portfolio. We'll be looking at the earnings growth rate, the average annual growth rate in earnings over the past 5 years for the stocks in the portfolio. We'll be looking at the PE ratio, which is the price of the index divided by the earnings for all the companies in the index. This helps judge how much we're paying for each unit of earnings. Then we'll look at return on equity. It's the amount expressed as a percentage earned on a company's common stock investment for a specific time frame. So this basically shows how well the company is utilizing the money. So if we compare these between the two indices, let's start with the earnings growth rate. For the US index, it's 19.1%, whereas ex-US is 14%. That is a major difference. Over the past 5 years, US companies have grown by almost 30 to 35% more than ex-US, or 5% more. For the next statistic is the PE ratio. So we're paying 27.5 times earnings for the US stock market index, whereas the ex-US index is 15.4x. This means the US is 78% more expensive compared to the earnings of the underlying companies that you're purchasing. Then for return on equity, ex-US has 12.1%, where the US index is almost double at 23.9%. So the US index looks much more efficient from a return on equity standpoint and a growth standpoint. And for that, investors have decided that they're willing to pay about 78% more for equivalent earnings in US companies. Now, PEs are backwards looking. So let's look at some trends over time. This is for the US and Canada or North America. And we can see that the US PE ratios are pretty high right now compared to the historical levels. And if they were to drop down to where they were between this time frame 2004 to say 2018, that would reflect a major price drop. Now, if we look at Europe, we can see that they're actually pretty cheap compared to historically, where the UK and Germany and France are roughly half the US almost, and some countries like Italy and Spain are even less than half. If we start looking at emerging markets, we can see India is actually quite expensive comparable to the US if we're evaluating based on PE. And some other countries in Asia Pacific are cheap relative to the US, South Korea, Malaysia, Indonesia, and so on. And historically, most of the ex-US are actually looking pretty low compared to their historical PE ratios if you compare them over time. And then when we look at Asia Pacific, New Zealand looks really expensive, but then Australia, Japan, Hong Kong, and Singapore all look attractive relative to the US if you evaluate based on price to earnings ratio. So while ex-US looks attractive based on the price-earnings ratio compared to history, the US looks like it's at a relatively high level compared to history. This is all backwards-looking data, and markets are actually forward-looking. They're not just looking at the history. They're looking, what's the expected price-earnings ratio in the future? What's the expected growth rate? What's the expected return on equity? How are different changes in laws or trends in markets affecting this? And this is really all the things the participants in the market are looking at when they're determining how to value a company. So the primary question is not, do you think, are US companies going to grow more and have a better return on equity, etc., than ex-US? The market is already doing that and assuming to some degree, and the prices reflect that. That's why the market is willing to pay 78% more for US companies than ex-US companies based on earnings. So the question is, will the US do even better than the market is already expecting relative to ex-US? And if so, how much better? And how much more are you willing to pay for that? You probably wouldn't want to pay 10 times more for the US index than ex-US based on price to earnings, but is 1.7x the current premium the correct premium? There are many other factors that may make the US look more attractive. We'll go over a couple of them. For example, the recent US election. It looks like the US is going to have lower corporate tax rates, lower tax rates overall on everybody, fewer regulations, and so on. This is very attractive for businesses to move to the US, for foreigners to move to the US, to earn a better living, and so on. This could make it more difficult for other economies to compete if companies are moving production to the US and high-skilled workers move to the US from around the world to invent, start companies, and so on. At the same time, many economies are struggling with population, where their populations are gradually declining, and they're relying a lot on immigration. And if we look at immigration trends, the US is at the leading end of those trends. We'll just look at a couple of them quickly. So global talent migrations, here we can see that the US is actually the top destination for international immigrants. People move there from around the world, followed by Canada, UK, Australia, and so on. There's also this Harvard Business School study or paper that talks about global talent flows. When was this written? 2016, so it is a little old, but it's still relevant. On page 2, so this study confirms what we saw in the previous slide, where patterns emerging which high-skilled migrants are heading for the US, UK, Canada, and Australia. Here, for some of the drivers of migration, we can see the US has a very wide earnings distribution and low tax levels and progressivity, especially compared to most source countries, including many high-income European countries. And as a result, we can see why the US would attract more high-skilled migrants. One of the final pages in this report is the migration of inventors from 2000 to 2010, where the US just completely dominates, and actually have a net outflow of inventor immigration from many other advanced economies. So you step back and look at the big picture. The incoming administration promising to lower taxes even further across the board, reduce regulations, be far more business friendly, looks like these trends could even accelerate with more people coming to the US or bringing their businesses to the US to take advantage of that. Now, there are many things to look at here. Like, the US has the world reserve currency. There are many advantages to the US. There are also disadvantages. Like, the national debt for the US is skyrocketing. There's a lot of other concerns. The population growth is primarily from immigration, so that could change depending on scenarios. So there's a lot of things to balance. We can't look at just the favorable or disfavorable things. And it's actually a very complex, interconnected system, the global economy. So forecasting this is extremely difficult. So do you have the proper skill set to evaluate all these complex factors to determine what is the appropriate premium to place on US versus ex-US companies. And this really brings us back to the indexing and diversification philosophy, because it is not about which companies, sectors, or countries will grow the most or do the best. That does matter. But what matters is what is the market already accounting for when it comes to these factors. So the market is already betting that the US will grow faster than ex-US. But how much is the question? What matters is your ability to spot the errors in the market. Hey, the market is underestimating that the US will grow even more than ex-US because of the recent changes in the election or population trends or whatever. Or they'll do even worse because it's not managing its growing national debt effectively, or whatever reasons you may have. So when we look at this hierarchy of companies, sectors, and countries, we look at companies. Which companies have the best strategies, management, capital, execution? Which ones are the market misunderstanding? Which have underappreciated risks from regulation, liabilities, inflation, interest rate movement, etc.? Which companies are under or over-evaluated in the market? We move to sectors. Which sectors are posed to grow more or be more profitable than what the market expects? Which sectors will see higher PE growth rates than the market already expects? Which sectors will see more capital flows than anticipated from trends like ESG? Now, this is where one of the fundamental premises of index investing comes in, is that we don't know the answer to these questions. We rely on the market to determine those answers for us and reflect that appropriately in the pricing of all these different companies or sectors in the market. But for some reason, many index investors only apply this logic below the white line. When we get to countries, we're evaluating which countries will have better or worse currencies, economic growth, high skilled immigration, etc., than the market already expects. Which countries' governments will help or hurt their economies more than the market expects. Many people make bets on this by overweighting their portfolio to the US or certain countries. And why is that? Do they actually have the skill to determine the global capital markets are underestimating certain countries' growth, profitability, and so on compared to the rest of the world? Do they believe global capital markets are not as efficient as the US markets? That the most sophisticated investors don't properly price companies globally, that governments may get in the way of market pricing, etc.? I'm not really sure, but for some reason, people do this and they decide to overweight their home country or certain countries that they may favor. There are literally millions of people participating in global markets. They're evaluating thousands of different criteria, analyzing massive amounts of data, trends, risks. They hire professionals in all different categories. And we just scratch the surface on some of the data to look at. They are digging extremely deep. They have far more expertise. This ranges from large hedge funds to individual traders. And they've already made their bets. This is already reflected in the price. So do you know better? I do not believe I know better, which is why I diversify globally. So far, it has not helped my portfolio, but that does not make it a bad decision. We have to make decisions based on the information we have in the moment. The information I have indicates that different countries do better or worse over long time periods, decades at a time. That markets are generally more efficient than me. That diversifying across asset classes has historically helped risk-adjusted returns. And that I have no reason to believe the US will continue to outperform ex-US above and beyond the expectations that are already reflected in the 1.7x PE premium. Now, unless you know better than me and better than the market, I don't see a good reason to make a gamble on it. That's my opinion. I'd be very interested to hear yours in the comments below, why you might overweight US. If you actually think you know better than the market or have another reason for it. If you got value from the video, make sure to press the like button and subscribe to support free financial education. Later.